Hello, thank you so much for watching Morning Markets. I'm Amber Kanwar. We've got a lot to cover right now, but the number one thing at this moment is a fresh read that we got on Canada's economy. For the first quarter, Canada's economy expanded well above expectations. And once again, it was on the back of Canadians that were spending. Spending was growing at the fastest pace in a year. And how did we achieve that? Well, we were dipping into our savings. Our personal savings rate is now at the lowest level since before the pandemic. Is this sustainable? And what does this mean for the Bank of Canada? Are they going to have to go back to the well when it comes to increasing interest rates? Let's bring in Stéfane Marion. He's chief economist at National Bank of Canada. Stéfane, thank you so much for joining us. The headline numbers suggest an economy that is robust, even in the face of, concerns that we should be slowing down. As always, the devil is in the details. What are the details telling you?
Well, as you said, Amber, the key takeaway this morning is the rebound in consumer spending. But that's all on the back of a massive drawdown in the savings rate. So as you said, we're back to pre-pandemic level. There's not much you can do going forward on that front. So we'll have to be on the back. If you're going to spend more, it's going to have to be on the back of rising disposable income. But disposable income was actually in contraction in the first quarter, Amber. So I think that the headline numbers surprise on the upside. Yeah, I get that for GDP, but some of the details of the report are not so good and suggest that we're seeing a significant loss of momentum as we enter the second quarter.
When the Bank of Canada estimated where Q1 would be, they put it somewhere around 2.3%. 3.1 is definitely well above their expectations. Even with kind of the underlying quality not there, does this perhaps mean that the Bank of Canada will have to increase interest rates at its next meeting in just a week's time?
I don't think so, Amber. When you look at the details of the report, you see double-digit declines in residential investment, double-digit decline in machinery equipment investment by corporations, and a double-digit decline in profits. All that suggests to me is that, the hiring pace will slow down quite significantly. And we're already seeing this to a certain extent in the labor markets, Amber, because the reason disposable income was down this quarter, in the first quarter, is because all the job creation has been skewed towards part-time employment in recent quarters. So I think that the previous impact of rate hikes is going to be felt more significantly in the second half this year on this side of the border. So I think it would be premature for the central bank to start hiking again in June just because the Q1 data was stronger than expected.
Having said that, the market's bet is that there will be a rate increase, perhaps not at the next meeting, but perhaps at some point in the fall. And I'll remind our viewers, there's been a lot of volatility. We came into the year expecting rate cuts, and now we're pricing in rate increases by the end of the year. What is the Bank of Canada's next move, do you think? What's the bias?
So the market has gone from one extreme to another, pricing rate cuts to pricing rate hikes. Perhaps the best thing to do is stay right in the middle right now. Let's not touch anything. Let's see what happens in the labor markets. And as you mentioned, the Chinese data is not really good. It does suggest a loss in momentum in that part of the world, which will take down commodities along with it. So we're going to see again real gross domestic income in Canada coming down, contracting the second quarter. And that's the purchasing power of the overall economy. So I think from a Bank of Canada standpoint, better stay put and see what the impact is in Canada of previous rate hikes, but also what's going to happen in the U.S. in the second half of the year. Now, I do understand that inflation is stickier than expected at this point in time. I would assume that it's going to come down the second half of the year. If not, they may have to resume with rate hikes. But I think June is too soon. July is too soon. Maybe this fall they have to do something, but we'll have to confirm whether or not we get this hiring labor market softness in both sides of the border.
Where is this recession? I'm starting to feel like the boy who cried wolf.
I think the recession probabilities are higher for next year than they were for this year. And this is where the market has to move. Our best guess at this point in time is that the real softness in Canada and the U.S. will start at the end of Q4. And be much more significant in the first half of 2024.
And what will drive that? I'm trying to get a sense of where the weakness was. We were concerned about housing. Then all of a sudden, housing is coming back as a pillar of strength for the economy. Where do you imagine the source of the weakness is going to be?
It's going to come from the impact of a profit margin compression on both sides of the border as corporations try to protect the profit margins. After a bad year last year, profit margins hit a record high in both Canada and U.S. As corporations have less pricing power going forward, they'll have to limit their hiring pace quite significantly, and that could mean job cuts in 2024, Amber. So I think that at the end of the day, everything is driven. Labor markets are driven by profits and profit margins, and we're seeing softness there, and that's going to come from labor market weakness in 2024. Unless
AI rides in to save the day, and many are using this as an example of where productivity is going to come from. I hear, I imagine your follow-up point will be, yes, but it will come at the expense of jobs. But maybe profit margins won't feel that hit because of the cost savings that AI will be able to deliver.
It's an interesting concept, Amber, and I don't want to dismiss it. I just don't think that can be deployed in 2023 or in 2024. Perhaps beyond that, it will have a more profound impact. But I just don't think that I could see that saving the day on productivity in the next 6 to 12 months.